All right, everyone, welcome back. This is part 2 of chapter 1. So, as we reviewed before, remember that there are 3 things that go into manufacturing costs, and these are, of course, the additions to our work in process inventory account. You'll see what I mean in just a bit. 3 things that go into manufacturing costs: the direct materials, and those are materials, raw materials that can be easily traced to individual units of production. I mean, costs can be easily traced to individual units of production. Direct labor, and those are labor costs that can also be easily traced to individual units of production. And then every other cost that's associated with manufacturing is the third piece. Everything that is not direct labor and not direct materials. That would be indirect materials, indirect labor, and everything else. Utility bills, rent, you name it, mortgage. If we're talking about manufacturing, a lot of the problems you're going to be seeing this semester are going to ask you or give you in the fact pattern that they are either cost associated with selling or cost associated with administration or something like that. If it is not associated with manufacturing, and you'll hear plant operations, factory operations, these are all synonyms to manufacturing operations. Factory, plant, or manufacturing plant. Any of those, if you're talking about costs that are associated there, it is manufacturing costs, and it's going to be manufacturing overhead unless it falls into direct labor or direct materials. More on that in a bit, but please get used to that concept. Anything that is non-manufacturing, I've alluded to this a little bit, would be either selling costs or administrative costs, okay? Selling costs are basically costs that are necessary to take customer orders and then finally to deliver products to customers. Everything you would think that a sales portion of a business would do. Administrative costs are everything else, right? All executive, organizational, clerical costs, manager salaries, things like that. However, even things like secretarial, receptionist, stuff like that, maybe at corporate offices or at the selling offices, maybe. But even those sorts of costs, if they are at the manufacturing plant, then they are manufacturing overhead, right? If they're not direct labor and not direct materials, but they're any other kind of cost, and I mean any kind of cost. I'm also talking about if we have to provide coffee for our employees at the manufacturing plant. Those costs, the cost of the coffee, would be an indirect material that would go into manufacturing overhead. Anything, if it is manufacturing related, goes into manufacturing overhead, except for direct materials and direct labor. Going to learn the concept of product cost and versus period cost in chapter 1 as well. And basically, product costs include direct materials, direct labor, and manufacturing overhead. Everything that we've discussed. And what I mean by that, and what the book means, is whenever we have an expenditure of money, if it is for any of those things, materials, labor, or overhead, well, that is actually a cost of our inventory, right? That's part of the cost of building the inventory that we plan on selling. Instead of going out and buying it and selling it, we build it ourselves. So first, it goes into our inventory. And then in the future, whenever we sell that finished good inventory, it will move from one of the inventory accounts into cost of goods sold. That's when it finally becomes an expense for us, right? When we make the sale, that's when it hits our income statement. However, period costs are not included in product costs. They're costs that aren't required for us to make or acquire our inventory. They are simply expensed as they happen every period. What I mean by that is, think about the sales office or an administrative office. If we pay our rent or utility bill for the month of, let's say, June, well, if it's July and we're paying the expenses for June, that's a prior cost. We've used up all of the value of that expenditure, right? We used it. It allowed us to operate our offices and or have electricity and see while we were in those offices for that month, but it's not going to provide us any future benefit. And those expenditures helped us generate revenue during that specific period, so they must be expensed in that period to match the revenues that they helped us generate. Whereas product costs, when we're paying for direct materials and direct labor and manufacturing overhead, we might be making all those expenditures, but they're not an expense. We're getting something in exchange for it. We're getting our products. We are building our products, and we will then own an asset, a finished good, which will provide us a future benefit, right? Our merchandise inventory, finished goods specifically, will provide us a future benefit because we can sell it and generate revenues in the future. So that's the difference between product costs and period costs. Remember, it all goes back to inventory systems. That's really what we're working with here, is the three main inventory accounts for a manufacturing company. Tracing costs through first the raw materials inventory account, then through the work in process account. But remember that the additions to the work in process account are a little more complicated than just the raw materials, right? It's specifically direct materials, direct labor costs, and all other manufacturing costs are what constitute the additions to the work in process inventory account. And what we'll do to track cost is we'll basically follow this rubric right here that you're looking at, and remember that's slide number 2 from your handouts, for all three accounts. For the raw materials, which is fairly simple, work in process, which is the most complicated of the three, and then finished goods. To do so, because we need to follow these three and it can get a little complicated, we'll be working with what's called the Schedule of Cost of Goods Manufactured. And it's really just a tool to calculate what I put there as CGM, the cost of goods manufactured. It calculates the cost of raw materials, direct labor, and manufacturing overhead used in production, and imputes that into the work in process account. And it calculates the manufacturing costs associated with goods that were finished during the period. It is also slide number 3, and this is what you're going to be working on for your homework. That's slide number 3. It's good to have out now, but I will reproduce it here, and it's good to have out during your homework. But it really is just, let me back up here a couple of slides. It really is just the inventory systems, slide number 2 from your handouts, reproduced 3 times. And this is what we will follow 3 times. Once for the raw materials, then again for work in process, then again for finished goods. So raw materials, basically, we take whatever is our beginning raw materials inventory, that'll be given to you, plus whatever other materials we go out and purchase. And remember, we're not talking about what materials, we're talking about the cost. Cost of the beginning raw materials inventory plus the cost of any new raw materials that we purchase gives us the total raw materials available for use in production during that period. What I mean is we can't use any other products if we didn't have it in beginning inventory or purchase it. Well, we're limited to what we had and what we've purchased. If you then look at raw materials at the end of the period and see that there is a certain amount, well, we will know that the rest was actually moved out and used in production. What I mean is, let's take that same example that we had before. Let's say we had $10,000 of beginning raw materials inventory, and we go out and purchase another 10, so we have $20,000 of raw materials that we can use. If we go look in ending inventory and there's only $2,000 of ending inventory, well, then we know that of the $20,000 that we had, we must have used $18,000 in production. What I mean in production is in manufacturing production. We are producing our products. So we take that amount that we use in production, and that is just one of the 3 things that is part of manufacturing costs. And remember, manufacturing costs is the equivalent of additions, not to the raw materials account, but to the next account, to the work in process account, right? We take what was in beginning inventory and we add to that direct materials, direct labor, and manufacturing overhead, which is collectively known as manufacturing costs. So this is how we get the first piece of the puzzle, the direct materials. Then we add direct labor, manufacturing overhead, and these are the total manufacturing costs for the period, which are the addition into work in process. So we would do the same rubric, right? We take the beginning work in process inventory, add to that the total manufacturing costs that were things that were added to manufacturing this period, and that gives us the total work in process for the period. Once again, if at the end of the period we go and subtract out what's left, well, the difference is what we actually finished in manufacturing. or the cost of goods manufactured for the period, right? And that cost of goods manufactured, meaning what we finished in work in process, now becomes the addition for the very next inventory account, which is of course finished goods. And these are things that are ready to be sold, right? And this is the equivalent, or the closest equivalent, to the merchandise inventory account of a regular merchandiser, right? It's what was in the beginning balance of finished goods inventory plus whatever we finished this period or what we manufactured this period. So add the cost of those goods. And this gives us the total cost of all goods available for sale. So again, let's say we had $1 million of goods available for sale this period, right? We had $500,000 already and we finished another $500,000, for example. And then we look and there's only $200,000 of inventory left at the end of the period. Well, we know that we then sold $800,000 worth of products. We can easily calculate that cost of goods sold. Again, that's slide number 2. It's the exact same rubric, the exact same mathematical equivalence every single time. And this is what it looks like all together. This is that slide, but basically we are moving, the reductions to each account are in essence the additions for the next account, with the exception that the reductions in the raw materials, meaning what was taken out of the raw materials account and moved into production, is just one of the 3 things that is the addition to the work in process account. Please take some time and understand this. I know it's difficult concepts, but I know you guys are all smart and can get this stuff, right? Chapter 1 of the book does also introduce various costs to you guys, but I will let you read those. We actually won't get into using and applying fixed costs and variable costs until much later into the chapter, but they do introduce the concepts here in Chapter 1. Please do read through the entire Chapter 1 and understand the differences between various types of costs, as well as they will come in key later in the chapter, or in the semester, but they're not necessary now, and we won't be applying them in Chapter 1. So please enjoy Chapter 1. Send me a message if you have any questions.